Going on, we're in the thick of earnings. We have midterms, obviously, and I believe today is a significant Montgomery cycle date. I'm going to throw that out there to prove I have been listening. So, November the 8th. I don't want to take away from your playbook. Let's get through to some of the highlights and dive right in.
Sure.
Top down.
Sure. Absolutely. So since you mentioned the Montgomery cycle turn date, today is a major Montgomery cycle turn date. It's one of two that we started talking about 3 or 4 months ago as being potential, market turning points where we actually at that time had been looking for a low. Believe it or not, the Tuesday, October 25th, was actually the first of those 2 Montgomery cycle turn dates that we've been talking about. And the NASDAQ actually rallied right into that and topped. So that is the recovery high from the October 13th low in both the NASDAQ 100 and the NASDAQ composite. Since that time, we've seen, a lot of back and forth. The S&P actually topped in terms of its recovery high on November 1st, and the Dow so far November 2nd. And so, here we are, November 8th. It's another cycle turn date. The question is this going to mark a significant turning point here in the market? We give it plus or minus 2 days because it's based on a lunar cycle and an eclipse that occurs, I believe, at 5:24 p.m. Eastern Standard Time today. So, with that, we kind of have today and tomorrow to kind of look at this as being significant to the market. But, our thinking is this. Number one, these time cycles are interesting, but they're not really significant to our analysis. Sometimes you need to be aware of them because, the analysis kind of coincides with that timing. It looks more like if there's going to be an important turn, it's going to be a top in some of these other indexes that haven't already put in their recovery highs. And, potentially we see a pretty strong rollover. That's been our view. We also have kind of an alternate thing, way of looking at the market as being there could be one more significant wave to the upside that, kind of caps this intermediate wave to counter trend advance. So, our thinking at this point is that it topped on November 1st, and we're looking for a rollover to the downside. We are in the midst of what I would define as a third of a third wave decline by our thinking. We're in primary wave 3 down and intermediate wave 3 down as a subdivision of that. And that could carry the market down as low as, say, 2,750 to 2,400 before we see any real significant reprieve in selling pressure. The next counter trend, if you will. Ultimately, we continue to think the S&P has considerable downside into the first quarter. Our target is 2250 on the S&P. If our count is right, then we should begin falling rather quickly. That being said, there's also an important piece of economic data that comes out on Thursday, and that's the CPI report. And most people, in fact, the consensus view is that print is going to tick down to about 7.9%. I would say that if it comes in hot again, that would be a catalyst for the market to accelerate to the downside. So, we'll look to that as being kind of the next catalyst, if you will, if nothing really happens here. But, we've been advising clients just to kind of stay on the sidelines here. Maximum cash reserves, minimum net equity exposures in terms of what your mandate will allow. And let's just see how this week plays out. And, we'll go from there.
So, Jeff, you've covered a lot in that opening statement, and we'll dig deeper into some of these bits along the way. One of the things that I'd like to discuss is volatility. It's been kind of somewhat subdued over the last several days, more than you'd expect, and it almost looks like we're oversold here, or it does look like we're oversold here.
We're as oversold as we've been in the last 5 years in terms of the VIX. We're just using a short-term, RSI oscillator to kind of monitor the momentum of the VIX's move, and we've got 21 consecutive down days. in a row in the VIX right now, and it's gotten to a point where, you know, in the past when we've become this oversold, it has preceded significant reversals in the trend of the VIX and effectively a volatility spike or surge in volatility. One of the things that we've been looking at in addition to the oversold, overbought sort of condition is the put call ratio. And if you look at the VIX open interest put call ratio, it is as low as it has been since February of 2020, just days before you know, one of the biggest crashes in equities in recent history occurred. And so, you know, we're at that point right now where, you know, it's kind of the calm before the crash, if you will. My thinking at this point is that, you know, people should be on alert for a surge in volatility.
So, Jeff, we haven't looked at the VVIX or the volatility on the volatility in the last couple of weeks. Is this telling a different story to the VIX?
What it's saying is that there's a positive divergence. And so, you know, in our experience and just kind of monitoring these two, you know, index gauges of volatility, you know, the top frame looks at the VIX itself and the bottom frame looks at the VVIX, the volatility of the VIX. And historically, when you've seen, you know, what we would describe as divergences, non-confirmations, if you will, either on the upside or the downside. For example, if we look all the way to the left side of the graph, you can see that, you know, when the VIX made a higher high, the VVIX made a lower high, and that resulted in a trend change that took the VIX lower. Now, if we look all the way to the right-hand side, you can see that as the VIX made its recent low yesterday, the VVIX below actually made a higher low. And so that positive divergence has historically resulted in the exact same opposite effect, right? You know, the VIX tends to respond to the upside on those conditions. And so, you know, from our analysis, just looking at how oversold conditions are, how complacent traders are about volatility in the market, and looking at this positive divergence now evident in the VVIX relative to the VIX, I would say that in the days ahead, we should expect a significant spike in volatility. And as we've said in the past, we haven't printed 40% or higher in the VIX in over 2 years now. And so it would not surprise me at all to see kind of this, you know, coalescence of surging in volatility with the decline in equity prices below their October 13th lows. I think that will be kind of the condition that results in, you know, the next big volatility crisis.
Now, you did touch on the possibility of like one lift higher before things sell off aggressively in your opening statement. I think I know the answer to this, but has anything really changed in your long-term model?
It hasn't. You know, this is a long-term trend following model that we've, you know, looked at for many, many years. And it's oftentimes, you know, there's some subjectivity to it, right? You see a model signal and you have to decide whether you believe that signal. Sometimes there are whipsaws. In the last 5 years, it's been pretty good. I got to be honest with you. And the most recent signal we received was in February of this year, as the market was breaking down. And so just to kind of describe it, we've got a simple moving average, which we define in red, and that's kind of the base trend moving average. And then we use an exponential moving average on a 3-to-2 ratio above it, okay? And so that exponential moving average is a faster moving average. And when it crosses below the red line, the green line crosses below the red line for all practical purposes, that's a signal. And so the last signal we got was a sell signal, and that suggests that the trend has changed. The long-term trend has changed to the downside, right? We have not seen another signal since. And until the green line crosses above the red line, in other words, that faster moving exponential moving average crosses above the base trend simple moving average, then the trend is down, and the model signal right now is negative. So, you know, a lot of people ask us, Jeff, what would it take for you to turn bullish? Well, you know, there's 3 things, right? But this is definitely one of the criteria that we are looking at seriously. If we did get a model signal that turned positive on this long-term trend following model, that would be the first indication that things are changing. And we would probably begin to scale back into the market on the long side, at least 1/3, right? There's two other criteria. We won't go into them today. We'll save that for a later discussion. But that would get us back in scaling into the market. So at this point, we're so far from that happening, it really doesn't even make sense to talk about it.
So Jeff, I thank you for breaking down how you're looking at this long-term trend model. So we kind of, it's like the Ghostbusters side, but a reverse of the Ghostbusters. We do want the streams to cross in this case to see a change in direction.
Exactly.
We should have done this on Halloween. I know everyone was dressing up as a Ghostbuster. Let's have a look at our old friend, the Elliott wave cycle, just to see if anything's changed on some of the levels.
Yeah, our top preferred count for the Elliott wave analysis remains unchanged. This is a cycle degree analysis. It's looking at a 13-year monthly view of the S&P 500 off the March 2009 low to the January 22 high. And from that point, what we've counted so far is 5 waves down at primary degree, which is primary wave 1 down, and 3 waves up at primary degree, which is primary wave 2 up. Since that time, we've come down and made a lower low in 5 waves down, which suggests that the next wave to the downside is now underway. That 5 waves down counts to us as intermediate wave 1 of primary wave 3. We are now in the midst of counter trend intermediate wave 2. So it's a counter trend advance that should retrace something like 50 to 61.8% of that first intermediate wave down. And we're pretty much there. It's possible that the S&P topped on November 1st, as we said earlier. It's also possible that there's just one more little move to the upside to get us as far as we need to go. We've kind of marked that as the 618 retracement. But at this point, I think that the real view here from a big picture perspective is be prepared for this, primary wave 3 down to carry the market into that 2750 to 2400 range before the next significant counter trend advance. One that would be kind of on balance, similar to the June-August advance, like a 20% type retrace or advance off these new lows that we're anticipating. That would be wave 4, primary wave 4 of this first cycle wave A down, okay? We don't expect cycle wave A to terminate until probably the first quarter of next year. That could carry the S&P into our longstanding target of 2250, and that would be the end of cycle wave A down. Now, these corrective patterns tend to be 3 waves. They're a motive wave, a corrective wave, and a motive wave. So the motive wave is 5 waves down. That's wave A. The next corrective wave would be wave B. That would retrace something like 1/3 to 2/3 of this entire wave A decline, which could get us, substantially higher, something very significant back into kind of the 4,000, maybe say 3,800 to 4,000 range. Once we got there, we would expect cycle wave C to the downside to ensue. Cycle wave C would carry the market down to a new low. We're not forecasting that low until we see how wave B trades out, but we've got a sense of where it's going to go. We think that could take it down into, kind of the sub 1,000 level, to be honest with you. And so, when we think about the entire correction of cycle wave 5 up, which is that 13-year advance, which we believe is part of a larger degree super cycle advance that began some 90 years ago, it's going to take some time and price to correct all that advance. And we think that could take years. So we're not looking forward to the next bull market for at least a couple of years to really even be thinking about it at this point.
Understood. And that move from B to C is the dramatic one, effectively. Anything on the alternate side?
Well, so these are short-term counts. So, we're looking at 120-minute bar chart, right, for the S&P 500. And this really illustrates what we've seen since the August 16th high. So on the left-hand side, this is our preferred alt number one, if you will. It counts intermediate wave down, or wave one down in 5 waves. And we've already recovered 50% of that decline so far in 3 waves, which we define in Elliott wave parlance as a double zigzag, WXY. That's intermediate wave 2. By this count, that topped on November 1st, and we've already traced 5 waves down. We can get a 5-wave count down. And so what we're seeing here is minor wave 1 down, and minor wave 2 is tracing up here. And the next move down will be minor wave 3 of intermediate wave 3 of primary wave 3 down. It's going to be a doozy, okay? Now, if we're wrong, okay, if the market, makes a new high, takes out that recovery high on November 1st, that's our second alt. And so what we're looking for then is, well, okay, we got the, WXY count, but that was really just at minor degree. And so that was probably, that was a minute degree. And so that was probably minor wave W. And the decline since then was probably an X wave, which means that we have minor wave Y to the upside, which could carry the S&P up to its 618 retracement, which is about 4,006 or so. So there is some leeway for that. We give this a much lower probability. I think, alternate 1 is, kind of a 65% probability. Alternate 2 is a 35% probability in my mind. At this point, we're looking for the market to trade hard down. But if we're wrong and we take out that November 1st high, then we don't think it's going very much higher.
Jeff, I'd like to pick on a couple of levels on alternate 2, if I may. Just 3,900 seems to be a level that's voiced quite, actively on the talking head shows and everything, with the S&P at a 17 times multiple at 230 earnings for the year. Do you see that playing into any of this as well, or would you, like, if alternate 2 went through, would you expect a hiccup around the 3,900 level, or would you just expect it to kind of blow through to 4,000?
Well, so alternate 1 shows that the market topped at 3,911, right? So I think all of the fundamental reasons that you laid out are kind of the reason why that's where it topped, okay? And so we rolled over from there. We broke a minor trend line. We traded down in 5 waves. That is all a telltale sign that the next move directionally is to the downside. Now, if for some reason the market reverses course sharply, takes out that 3,911 level on November 1st and moves up to 4,000, that's kind of the next logical place for it to go. Once it breaks out above 3,911, 4,006 or 4,008, one of those two is where it is. That's the exact 61.8% retracement of minor wave 1 down off that August 16th high. So that would be where we would expect it to stop and reverse then to the downside from there. So, both of the counts are bearish. One of them is just short-term, less bearish than the other.
Got it. Let's have a look at internals. Is it fair to say that things are a little bit more positive on this side?
No doubt. We've gotten back to neutral. So no longer are the internals deeply oversold like they were. We saw some divergences. The first was in the breadth, where we made a lower low in October than we had back in kind of that May-June timeframe. Momentum in the middle frame made a higher low. That also gave us some indication that we're poised for a bit of a bounce. Momentum carried up into the a positive regime, but now it's traded back below the median line again. So now we're in kind of a bearish regime and momentum right now. It remains to be seen whether that corrects itself by the end of the week. These are 5-week studies, so they're very short-term in nature. But back to the breadth, we did turn positive from deeply negative levels on the 5-week net percent of net advancing issues. And so, that kind of gets us squarely back into neutral territory. momentum a little less so, and then volume actually has improved quite a bit. We look at the the 5-week moving average of up-down volume for the S&P 500, and that's back to 3.2. So that's kind of a neutral-ish level. In fact, last week up volume was about 77% of total S&P volume. Not, fantastic, but not horrible either. So, I would say the internals are just kind of neutral right now. They're not signaling bullish condition. They're just not signaling the depths of despair either. So, we kind of like the setup here that neutral is good for, the bear case. It kind of takes off the edge, right, where people are over positioned one way or the other. They're just neutral at this point.
And it looks like investor sentiment's painting a fairly similar picture as well.
Yeah, I was really surprised to see the American Association of Individual Investors, this AAII study that has historically been really bearish. It's been historically very, very bearish. And that's moved back up to a bear bull spread of just -2%. So, from the perspective that individuals remain bearish, I think that's off the table at this point. They are neutral. Now, it's less that condition for professionals. The National Association of Active Investment Managers, that is actually ticked back to about 55% net equity exposure. That's at the low end of the normal range, which is 50 to 100%, midpoint being 75%. They had been deeply underexposed down to like 15% as recently as about 3-4 weeks ago. Now we're back into that kind of normal range. So, I'd say it's near neutral there. But in general, this is not a condition where investors are positioned fearfully. They're positioned really because they think we're going to see a big rally. And the talk has been that, the seasonal time frame to be long stocks is post-October. October's the bear killer. You got a midterm election. Stocks are always higher 3, 6, and 12 months later. Not always, okay? About 70% of the time, the seasonal trade works. And statistically, we're really only looking at, back to 1957 for those post-election sort of results. So, it's 18 samples that we're taking a look at. It's not a very big series or very big sample pool. So, I don't think we can really read a lot into those seasonals. Honestly, I think it's BS.
All right. Well, thank you for self-regulating your language there, just for the viewers. Let's have a look at our old friend value versus growth. This has been a great trade over the year. How are we looking now?
Yeah, we're looking great. Value obviously has seen a big benefit in rotation terms, right? You've seen FANG, technology, communications really get crushed this year, this month, this week, right? Money has been rotating out of that, and it's been rotating into the value sectors of the market, right? Value securities in the market, individual equities. And so, we look at the S&P pure value to pure growth ratio. That's the black line. We've shown it against the 10-year Treasury yield. And there's been about an 84% correlation looking back over the last 15 years between those two. Now, as bond yields have risen aggressively, we have expected value to outperform growth. And it got a little bit of a hiccup there. It had to pull back. It checked back to its prior breakout level in 2021, but it has now reasserted itself and broken out again. And we think it's probably off to the races here. So, after a brief hiatus, I think the value trade's back on, and, it should move forcefully higher as rates continue to surge higher. And we expect rates to continue to surge higher.
That's a very compelling looking chart there. It looks like a coiled spring about to go. So keep an eye on that one. Jeff, any sectors of note for the week?
The only thing I would really mention is, like I said a minute ago, tech got crushed last week. Also, comm services, which is largely just, internet and media, so it's all kind of that tech area, tech and communications, down over 6%, both of them. Meanwhile, energy was up a couple of percent, and we continue to see things like materials, staples, healthcare do better, right? And so I think from the standpoint of where we should be making our bets right now, three sectors that I really like are basically energy, top of mind, industrials, and financials. Those three seem like they're starting to see fund flows, right? Money's rotating away from growth into those sectors. The defensives like utilities, staples, healthcare are also areas I would continue to favor over tech, discretionary, and comm, which have been really super weak. And we want to continue to avoid those areas.
So a lot of volatility in our futures. How do we make some money, Jeff?
Yeah. On the long side, I like an energy stock called Diamondback Energy, symbol FANG, FANG, not to be confused with the FANG stocks. In fact, quite the opposite. But, we've got like a 6-month base here that's resolved to the upside. The breakout above 155 gives us the ability to account an upside measured move target to 215. That's 30% to the upside if it's realized. As a risk budget, we would set a stop loss at 149. That sets up a better than 3-to-1 positive risk skew on this long.
And I'm sure you have lots of choices for the short side, but which one comes to mind now?
Well, honestly, we really wrestled with this. I almost went out with Tesla again for maybe the third or fourth time. I continue to think that stock has a lot of downside, but Live Nation really is the one that jumped off the page to me this week as really having, just the quintessential perfect chart, right? This is a 3-year look at Live Nation Entertainment. The stock broke trend months ago. It has been hovering above a key support level that marked really the kind of 2019, 2020 highs, and has put in a perfect head and shoulders top formation. Now, the breakdown below 75 gives us the ability to count initially a target to $50. But if it continues to go, we can actually get a stretch target to around $25 to the downside. That's about 30 to 65% return for a short seller here. We would definitely use a risk budget of around $80 is where we'd set our stop loss. That sets up a nice 3-to-1 positive risk skew to our initial $50 target.
Well, fantastic. Thank you for sharing that, Jeff. I will say, if I was a betting man, I would have said you were going to go with Tesla after I saw it as part of your package this week. So, but Live Nation it is on the short side. Jeff, as always, thank you so much for sharing your thoughts from Alpha Insights.
You're welcome. It's always a pleasure.
And for our viewers, I would urge you to check out Jeff's work at Alpha Insights. You can subscribe here and learn a lot more about different asset classes and a bit more positioning on some wider variety of stocks. So check it out. And don't forget, a little shout out for our friend Stu for making this go live today. And until next week, thank you for watching and good luck investing.